Hello and welcome to this month's Financial Markets Update. Well, March proved to be another solid month for financial markets. We saw some really strong investment performance right across all the major asset classes over the course of the month, and this really capped off a very strong first quarter for 2024, particularly when looking at the performance of equity markets as well as the domestic REIT market, which enjoyed a really strong rally, not only over the month of March, but throughout the first quarter. Bond markets were up over March. We saw some solid investment performance from our local bond market, but interestingly enough, when looking at the performance of bond markets over the first quarter, certainly couldn't mirror the performance that we saw in equity markets, particularly whether it be domestic or global equity markets. And the rally that we've seen in global equities as well as domestic equities has really been driven by that ongoing performance, particularly out of technology-related stocks. And we saw that throughout the course of February, particularly with companies such as Nvidia up over 25% on the back of some solid earnings results. So interestingly, as said, the strength in financial markets has really been driven by equity markets particularly, and this is against a backdrop that continues to show that inflationary expectations remain relatively sticky, and the move to having central banks cut rates really has been pushed out throughout the course of this year, not only in terms of when they are likely to move, but equally the speed and, as I said, the extent by which central banks are going to move throughout the course of 2024. And we're looking at the performance of financial markets. I thought it'd be interesting just to focus on a couple of charts here, and you can see here this chart really is just showing the divergence between the MSCI World Growth Index versus the Value Index. And unsurprisingly, as we've seen, particularly over the last 12 to 18 months, where the growth has really started to come to the fore, and we've really seen that most overtly through the technology index, and you can see the comparable there in terms of the global technology index and the performance of that relative to the broader global equity market. And as I say, that certainly growth sectors have delivered on that, and that's really been driven by the tech sector. Now, the question from our perspective, and certainly what we're spending some time on at the moment, is whether or not we think this can continue, because you can see quite a significant divergence in performance. In our view, it's unlikely that we're going to continue to see this level of outperformance as we move through the back half of this calendar year, but we do expect that quality earnings and quality growth will continue to deliver a better outcome for investors, certainly should we start to see some rate cuts come through the second half of this year. And in our view, as I said, even though there is quite a level of divergence between the two investment styles, we still believe that growth can continue to outperform throughout the course of this year and over the medium term. But in saying that, we don't think the relative level of that performance is going to continue. And we're just focusing on the rate cycle because, again, we've seen inflation prints continue to remain above market forecasts, and clearly showing that whilst inflation has moderated over the last 12 to 18 months, still remains well elevated relative to central bank target levels and where central banks arguably think the inflation rate should be. And this is really on the back of a continuing strong economy, particularly out of the US, which is really leading the way. We continue to see the unemployment print continue to look strong. Consumer spending by and large looks okay, and that is really just fed into ongoing service price inflation as opposed to goods, which was sort of the primary focus coming out of COVID. So I've seen that shift, but notwithstanding that, inflation continues to remain relatively sticky on that basis. And just comparing, said these two charts here, and I think it really, chart on the left pointing to the break-even inflation rate in the US 1 year out versus the expectations of where inflation is going to be 5 years out. And you can see from the 12-month outlook versus a 5-year outlook, inflation is still expected to be north of 4% versus sort of 2.5% over the next 3 to 5 years, certainly over that medium term. So from our perspective, when you're looking at that, it's not surprising that central banks, particularly the US Fed, are a lot more cautious in the way that they're positioning any likelihood of future rate cuts. And again, you can see that with the chart on the right-hand side, which is actually showing sort of the changing nature of the Fed dot plot, so the expectations of where cash rates will be going over the next 12 months or so, as well as a number of either rate hikes or rate cuts. We're not expecting any rate hikes throughout the course of 2024, but certainly the speed of those rate cuts between December and the end of March has been dialed back significantly. And from that perspective, as I said, a lot of that has to do with the fact that inflationary expectations, certainly over the next 12 months or so, continue to remain elevated relative to where we see inflation over the next sort of 3 to 5 years. So in that context, it's unsurprising that central banks, both in the US as well as right around the world, including Australia, are certainly more cautious on the outlook for inflation and what that then means for rate cuts. In our view, when we think about it domestically, unless the unemployment side of things, and we are getting closer, we do expect the unemployment rate with the next data print will probably be closer to 4%. So that's a psychological level that we think the market will certainly hang on in the near term. But as I said, we're not expecting any shift near term on cash rates if labour markets do remain sound and overall economic activity also continues to remain solid. So all in all, a really solid month for financial markets over the course of March, and this really, as I said, capped off a very strong first quarter for 2024. Our expectations as we sit here today is that market earnings can continue to push higher, but we do think pretty much markets are looking fairly valued right across multiple metrics. Wouldn't say they're outright expensive, but it wouldn't surprise us, as I said, as we head through the early part of this second quarter, we do see some pullback in financial markets, and we're not expecting, as I said, the second quarter to be as strong as what we've seen through March. But I think it does highlight the importance that having a growth tilt within the portfolio, certainly in our view, is probably the most important way to go at this time, albeit be mindful of the risks of, as I said, just adding too much growth too soon, just given the backdrop of the macro, as well as obviously some of the geopolitical issues that we're seeing at this present point in time. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and we look forward to catching up again next month. Thanks, and bye for now.